That right there is the perfect way to frame it, because you've got this massive uh, intellectual and even moral gulf in how we talk about the economy. The answer really depends entirely on what you choose to measure. I mean, if you look at the ledger sheets, right, the central bank's balance sheets, the policy is working. You see macroeconomic indicators stabilizing, inflation figures are cooling down.
Hmm.
But then you talk to actual people. The vast majority of citizens who need credit just to live, to buy a home, finance a car, or God forbid, run a small business. And for them, they're just being crushed. It feels like they're being structurally punished just for trying to participate in the economy.
Well, that is precisely the tension we have to navigate today, and it really forms the basis of our disagreement. I'm going to argue that the aggressive use of high interest rates is really the only effective, historically proven tool we have for the paramount goal of price stability, and that a failure to act, well, it would have resulted in an inflationary spiral, which would have harmed the vulnerable far more severely than these rate hikes do.
And I'm going to argue that while, yes, the Fed's policy might stabilize some abstract markets and give us comfortable headline numbers, the mechanism for that stability is just fundamentally inequitable. The burden is targeted. It imposes these catastrophic, and I'd say often permanent costs on people who are leveraged, everyday borrowers, young families, basically anyone without a pile of assets to shelter them.
Okay, so let's establish the context here clearly. Just 2 years ago, inflation was running hot. I mean, hotter than anything we'd seen in decades. You had input costs rising, labor demands going up, and prices were surging faster than wages, which was gutting purchasing power for everyone. So if the central bank had hesitated, if it hadn't acted decisively by, rapidly shifting the federal funds rate from near zero up to where it is now, we've risked embedding those inflationary expectations deep into the system. Right, prices to cover those wages, and then the currency just loses value. That scenario, runaway inflation, is pure economic chaos. And history proves time and again, it's the poor and the middle class, the people who save in cash and rely on predictable costs who are just decimated by it. They lose everything.
Look, I agree 100% that high inflation is corrosive. It has to be managed. But my perspective is the solution that we've prescribed, these high interest rates, it is structurally designed to impose pain on the consumer to get demand down. Historically, yes, that's what central banks do. They raise the cost of capital to slow spending. But we can't just separate the efficacy of the tool from the equity of the outcome. You're saying because the alternative is chaos, this painful solution is justified. I'm arguing the cure itself introduces a structural injustice.
But the logic is sound, isn't it? It's the best tool we have. We make money more expensive. That slows down borrowing. It reduces demand for goods, for labor, and the economy can find a more sustainable equilibrium. I mean, this is the only reliable lever central banks really possess to restore that long-term stability. Failure to administer this tough medicine, it risks a far greater illness, one that could cause a total loss of faith in our financial structures.
But let's not pretend this medicine is some kind of clean surgical strike. It's a scattershot cure, and I just don't buy that the solution is to make core life milestones, like buying a house or expanding a business, virtually impossible for anyone who's operating on the margin. This policy, it prioritizes stabilizing abstract numbers, the CPI, the unemployment rate, while it creates this widespread, very acute financial distress. Just look at the real numbers for a second. A 30-year fixed mortgage goes from 3% to 7.5%. Credit card rates are hovering near 22%. Those aren't abstract figures. Those are the monthly payments that are pushing families to the brink.
And that brings us directly to the crux of it, doesn't it? The locus of pain. Who bears the cost of this policy? And is that cost genuinely necessary for the eventual collective good?
Absolutely. Let's really detail the impact here. When the Fed moves that funds rate up, who feels it? Who feels that immediate, crushing impact? It is the leveraged segment. It's the young professional whose salary just barely gets them an apartment rental that's eating up 40% of their income. They're trying desperately to save a down payment, but their savings account yields pennies while their credit card balances, which they're using just to bridge gaps, are spiking. It is the first-time homebuyer who sees a $400,000 mortgage payment jump by $1,000 a month. It just makes a purchase impossible.
I appreciate the specific examples, I do. But the counterfactual here is just so crucial. While yes, current borrowers are feeling acute pain, allowing inflation to continue gutting the savings of those exact same groups year after year, that would have been a slower, more insidious kind of destruction. We are enduring short-term volatility to achieve long-term value preservation.
But just contrast the scale of the pain for a moment. Wall Street, sophisticated financial institutions, they adapt to this stuff swiftly. They can hedge against rising rates, they benefit from higher yields on T-bills, and big corporations who already leveraged years of near-zero rates, they're sitting on massive cash reserves. The wealthy who hold assets, stocks, real estate, they don't have to sell. They actually benefit from this stability and the higher returns on safe investments. They don't use 20% interest credit cards. They get paid to wait. The middle class, however, is just being told to pay more interest.
I see why you frame it that way, as a benefit to the asset class. But I think that framing ignores the structural reality of stabilization. The pain you describe, it's economically necessary. It is a temporary slowing that's required to achieve long-term, sustainable stability. Ultimately, restoring the purchasing power of the dollar is the only path that makes future planning for those very same families possible again. Without a stable dollar, you can't invest, you can't save, you can't plan for anything.
I'm sorry, I just have to push back on this idea that the pain is temporary. Temporary for who? For a multi-billion-dollar hedge fund, a few years of high rates is a cyclical challenge that they monetize. But for a 32-year-old nurse who is now priced out of ever entering the housing market, that financial consequence is not cyclical. It feels permanent. It permanently alters their entire wealth accumulation trajectory. Their one chance to build equity is gone, and they stay in the renter class. And that fundamentally erodes the core promise of upward mobility. It's a destruction of human capital investment. When you stop people from securing stable assets, you discourage long-term investment in skills, in education, in risk-taking.
That is a compelling argument, but it's based on social outcome. We have to circle back to the institutional constraints. The emotional weight of the American dream aside, we have to remember what the Federal Reserve's purpose is. Their official mandate is strictly price stability and maximizing employment. It is not achieving specific social outcomes or wealth redistribution. They are legally constrained in the tools they can use.
And that is precisely the systemic failure that I'm trying to highlight. The institution's narrow, singular focus on that dual mandate, it exists within an economic structure that consistently asks the same people, those without a generational head start, those without significant assets, to pay the steepest price every single time there's a correction. The way it's set up now, it means that when the economy gets too hot, the official remedy is explicitly designed to make life unaffordable for the very people who are trying hardest to climb the economic ladder.
But you can't just ignore the mandate because the results are difficult. They are executing the mission they were assigned by Congress. If you want social equity factored into interest rates, you have to change the law or provide new fiscal tools. That's the job of the legislature, not the central bank. The central bank has to remain non-political, focused on the technical goal of balancing aggregate demand. I understand the bureaucratic defense, I really do, but when the technical implementation of that mandate results in the systematic erosion of fundamental societal expectations, the basic ability to buy a home or start a business, then the technical implementation itself has to be critiqued. The expectation used to be, work hard, save money, buy a home, build equity. Now it's devolved into, work harder, take on more and more high-interest debt just to stay where you are, and you still might never own anything. The facts, metrics, the numbers, they might look stable,
But that directly conflicts with individual realities, where lives feel deeply unstable. The system is asking people to sacrifice their future for the stability of the present financial architecture. Okay, I see why you're concerned with the distribution of the hardship, but let me pose a different question, a practical one. If we accept the premise that the only way to tackle sustained structural inflation is to curb demand by making money more expensive, then what is your substantive, credible alternative? Are you suggesting we should just let inflation run rampant? We both agree that's catastrophic. Or are you advocating for something like credit controls, which have their own long, ugly history of inefficiency?
No, of course not. I am stating explicitly that the alternative is not letting inflation run wild. My point is that we have to stop treating interest rate policy as if it were this clean, neutral economic lever. It's not. It is an extremely blunt political instrument that specifically and disproportionately hits leveraged people without assets the hardest. If the Fed just acknowledged this inequity, they might use the tool with more precision, or at least coordinate better with fiscal policy to offset some of the pain.
But the efficacy of the tool lies precisely in its broad, uniform application. If it only hit the rich or only hit the poor, it wouldn't be effective at cooling aggregate demand. To cool the economy, you have to cool everything. And let's just, for a moment, extend this globally. U.S. rate hikes, by strengthening the dollar, provide a degree of stability for global capital. If the U.S. economy spirals, it takes the entire global financial order with it. Our stability, achieved through these rates, is a necessary anchor for the world.
That is the quintessential defense of capital over people. You argue U.S. stability is a global good, but rising U.S. rates often mean we're just exporting our financial pain. A stronger dollar makes dollar-denominated debt in emerging markets cripplingly expensive. It triggers crises elsewhere, so we sacrifice the young American family and we destabilize developing nations, all in the name of technical price stability. That is a massive cost.
That is a fair point regarding the externalized costs, but have you considered that maybe the Fed isn't consciously choosing stability over people, but rather choosing a system that ensures the long-term viability of capital markets first? It's a question of sequence. You can't achieve societal equity on a foundation of monetary instability. You have to stabilize the currency first, and then, and only then, can policymakers begin to address the distribution of wealth through separate fiscal tools.
But if the cost of building that stable foundation is pushing an entire generation into being perpetual renters and high-interest debtors, if the cost is the destruction of upward mobility, then I argue that foundation is inherently shaky. The policy reveals a deep structural bias. It protects financialized capital, it ensures returns for asset holders, and then it just hopes that the middle class can survive the process. And the evidence suggests that survival is becoming unaffordable, and the dream is dying for a huge portion of the population. You know, this discussion really highlights the profound and inescapable trade-offs that are just inherent in central banking.
I have to briefly reiterate my central position. Central bank intervention using high rates wasn't arbitrary. It was vitally necessary to ensure macroeconomic stability and prevent a catastrophic inflationary spiral.
And while I fully acknowledge the difficult trade-offs and the very real immediate pain on borrowers, the alternative, a total collapse in purchasing power, presented a far greater, more systemic threat to the economy itself. And I have to reiterate the central moral and economic challenge here. We cannot justify the efficacy of this policy just by looking at charts showing cooling inflation. We have to weigh it against its deep structural inequities. The current approach threatens the long-term economic vitality of the middle class by systematically making the costs of entry for housing, for business, for education prohibitive. This is a self-inflicted wound on our own future.
So perhaps the core question transcends whether the Fed's policy is technically right or wrong, or if they perfectly executed their specific mandate.
Right. It's about whether an economy can truly be considered healthy at all, if it achieves stability on paper, while a huge portion of its working people are struggling, losing ground, and are systematically blocked from even securing a future.
And maybe that is why this debate, which is ostensibly about two men arguing over finance, feels so fundamentally heavy and so personal to so many people right now.
Because interest rates aren't just dry numbers. They are the gatekeepers. They decide who gets to secure a financial future, who gets to start a family with a home, and who is forced to wait for the next cycle to maybe finally afford their ticket in. And this tension between macroeconomic stability and social equity, that remains the most critical unresolved issue facing policymakers today.